Hey everybody, and welcome. If you're new to the mortgage process and haven't already, make sure you go stop and check out the playlist section of my channel and watch my first time buyer playlist. It's called Guiding Your Mortgage, Learn Mortgage in an Hour. That's where you'll learn everything that I would want to know if I didn't know anything about this myself. And also please share this channel with a friend that's looking to buy in the next year or two. All right, so I've shared with you the main dominant 0% down loan programs geared towards first-time buyers in the DC, Maryland, and Virginia area. The way most of them work is they have a maximum loan, either 96.5 or 97% of the purchase price, and then they back that up with a grant covering either 2% of the rest of the purchase price or a second loan covering the rest of the purchase price, or even the rest of the purchase price and some of the closing costs. Usually for these, you have to be under an income limit. You have to be a first-time buyer in a lot of cases. You can't have a non-occupying co-borrower or a co-signer in that case. And the debt-to-income ratios can be a little bit restricted. Now for this loan, why it's so special is because there are these 4 major loopholes that those traditional 0% down programs do not have for you folks. Basically, this loan is going to allow a lot more of you to buy with that loan structuring, that big first loan with a second loan behind it, and not have to do 3% down because of these 4 things. Okay, number 1, non-occupying co-borrowers are allowed on this loan. That's a co-signer, that's like mom or dad putting more income on the file with you to help you qualify for the payment. That co-signer's income just can't make up more than 30% of the total file's income. Then number 2 loophole is repeat buyers can use this. You can literally already have another house before you buy this in some cases. Number 3, income limits are very relaxed here. And then number 4, your debt to income ratio can go up to 55% if your credit score is over 680. Usually they'd only allow you to go up to like 45 or 50. The way it works is this, and by the way, I say DC, Maryland, Virginia, and Texas because those are the 4 states I'm licensed in. Those are the 4 ones I can help you in. But it's going to be a FHA purchase loan. So they're going to give you the maximum 96.5% of the purchase price in a loan as your first trust loan. And then behind that, they're going to give you a second loan that's equal to 3.5 or 5% of the purchase price. Now, you can't get that second loan to be anywhere in between 3.5 or 5%. It has to be one or the other, and the 5% one is much more popular. But the second loan, it must be repaid over a 10-year period. There's no prepayment penalties on it. It does require a monthly payment, and the rate is 2% above the rate of the first big loan, but it's a small loan compared to the first one, and the increased rate really doesn't even look that bad. Now for some of the nuts and bolts here, there is an education program required to be passed before you close. It's a 620 minimum credit score. Green card holders and permanent resident aliens are allowed to buy with this. It's not just open to citizens. We do this loan in-house, so we don't have to send this over to a state or local agency for approval, a separate approval before closing, which can really slow things down. So we keep this to 30-day closes, don't have to go out to like 40, 50 days on it. And there's no rule, if you buy with this loan, there's no rule against you renting this house out after 12 months. A lot of those other programs, they have that restriction as well. And then you get to have 160% of the area median income level. Most other first-time buyer programs, they cap you out at 80%, 100 or 120% of the actual area median income level. So this is much more relaxed. And then non-occupying co-borrowers, like I said before, can contribute income to where it makes up a maximum of 30% of the income of the file. Now that non-occupying co-borrower, their income will not go towards the household income, which could potentially wreck your status of getting under the 160% level of the area median income limit. 2 drawbacks here. There is what's called a 1% origination fee. It's 1% of a loan fee of the first loan amount, can't be waived or reduced. So if you bought a house with a loan of $300,000, then 1% of that is $3,000, which would be a fee on your closing cost sheet. then there's a payment shock rule. In most all cases here, your new payment can't be more than 225% of your old rent amount, your old housing payment. Now, finally, let's think of the numbers for this. So if you were going to buy a house, your first house at $300,000, do it 3% down and then 3 to 4% for closing costs. So you could imagine to spend somewhere between $19,000 to $22,000 roughly in closing day. But with this program, that same $300,000 house is going to have a bit higher on the closing costs. It should have closer to 4%, but then a big chunk of your closing costs are going to be taken care of with that 5% second loan option. So you're looking at only having to bring on that same $300,000 house about roughly $6,000 to $9,000 on closing day. And that's before asking the sellers for help. Okay, you can always ask your buyer agent to negotiate the seller to give you some closing cost help on closing day. So awesome. That is, could even bring you down to almost $0 cash to close on closing day. It's really a miraculous loan. It's why these are so popular. But guys, that's about it. The 4 loopholes explained earlier are what makes this program so amazing. It opens up the ability for you to do a 0% down, whereas if you needed one of those loopholes on a traditional 0% down loan, you wouldn't have the ability. Again, if you're a first-time home buyer, make sure you go and check out the first-time buyer playlist in the playlist section of this channel. It's called Guiding Your Mortgage, Learn Mortgage in an Hour. And that playlist is going to bring you fantastic confidence and give you a very strong idea of what you have to do to qualify, close, and manage the payment of the mortgage in the future. Thank you, guys.